Have you heard about infinite banking? An economist, Nelson Nash, came up with this concept. Basically, it treats a cash value life insurance policy as your personal bank account that you can borrow money from. Sounds good, right? But does it fit your situation? In today's video, we'll provide you with a complete understanding of how the infinite banking concept works, its pros and its cons, and for whom the infinite banking concept is a good fit. I'm Greg Rosdiba, the CEO and founder of Dundas Life. We're a digital life insurance brokerage based in Canada. Our mission is to help individuals navigate insurance and financial planning. If you're interested in learning more, visit the link in the video description below. Let's dive in. Infinite banking is a new financial strategy that uses a special type of whole life insurance. It allows you to access capital without borrowing money from a lender. Basically, your whole life insurance policy acts as your personal banking system. It provides you with cash whenever you need it at a lower interest rate than banks or credit unions offer. Your policy earns dividends, and its cash value continues to grow even if you borrow more money. You can use the cash value to fund major expenses, such as your child's education, student loans, car loans, or a down payment on a home. When you pass away, your beneficiaries receive a tax-free benefit from the leftover cash value in the policy. So how does infinite banking work? Infinite banking typically uses an overfunded participating whole life policy. You may be wondering, what is an overfunded participating whole life policy? Can't you use standard whole life insurance instead? While a standard whole life policy can help you create a personal line of credit, it isn't nearly as effective as an overfunded whole life plan. Compared to a normal whole life policy, the latter one grows cash value more quickly, which means you will be able to take out a loan sooner. It also can potentially accumulate more cash value, which means you would be able to borrow more. Compared to non-participating plans, participating plans earn dividends, making them a better fit. Now you might wonder, should I use whole life insurance for infinite banking? Here's the answer. Whole life insurance is the preferred insurance tool to implement the infinite banking concept. You essentially combine life insurance with an investment component, which serves as a financial safety net and helps you accumulate wealth in a tax-deferred way. Some people may argue that buying universal life insurance is risky, since the cash value growth depends on stock market conditions. It can also have negative returns. So this is something to keep in mind when doing this kind of planning. So how do we get started with the infinite banking concept? First, it makes sense to get started early. Since life insurance costs increase with age, you can lock in a lower monthly insurance rate early. Second, since this is a long-term contract, choose a financially stable insurance company. The easiest way to check an insurance company's financial stability is to check their financial rating, such as AM Best. Third, select a participating whole life insurance policy. Fourth, choose a paid-up addition rider, which may work to earn dividends and speed up the accumulation. Then, once your policy has enough cash value, you can start leveraging it by taking out policy loans tax-free. Finally, remember to repay the loan. If you don't repay the loan, your death benefit will be reduced at the time of your death. Now let's talk about how infinite banking loans work. The first step is to allocate monthly funds to pay your policy. We recommend to allocate no more than 10% of your monthly income. Once you've accumulated enough cash value, you can leverage it as collateral to borrow money from the insurer. In the early stages, your policy loan remains tax exempt because of its high cost basis. However, as the years progress, the cost basis starts to decrease, potentially making it taxable in Canada. The insurance company will charge you interest on the borrowed amount. However, one of the attractive features of the infinite banking concept is that the interest rate is typically lower than a loan from your bank. Even while you're borrowing, the entire cash value of your policy continues to compound. This means that your money can keep growing regardless of whether you have a loan outstanding. If you have a participating permanent life insurance policy, you can further boost your cash value growth using the annual dividend payments. Now, it's important to note that you have the flexibility to repay the loaned amount and interest to the insurer at any time. So what exactly are the benefits of infinite banking? First, the infinite banking concept, or whole life insurance, is a non-correlated asset, which is one of the biggest pros of infinite banking. That means there is no correlation to the stock market. It can help to diversify your investment portfolio. Second, you can get quick access cash flow. Usually it takes a few days to receive a policy loan, but for home equity, you need at least 30 days to convert it into cash. That's because home equity isn't liquid. If you're interested, here are 3 main options to unlock your home equity: a home equity line of credit or a HELOC, selling your property, or a cash out refinance. Third, also included are other features like a death benefit, cash value accumulation, level premium, and compound accumulation. Plus, participating plans pay dividends. Fourth, the infinite banking concept provides several guarantees, such as guaranteed loans. This means that once the cash value of your policy has grown to a certain amount, you can borrow against it at any time. Unlike other borrowing methods, infinite banking allows you to convert a compounding asset into cash on very short notice. Otherwise, you can borrow against a brokerage account or real estate, but you may not be able to turn it into cash immediately. Fifth, a tax-free death benefit is guaranteed. Depending on the insurer, you could even tap into the death benefit while you're still alive. Sixth, your life insurance is protected from creditors in the event of a bankruptcy. Finally, you have privacy of records. Whenever you take out a loan or withdraw money from your account, no credit report would be shown. Now, let's cover a few of the downsides of the infinite banking concept. First, the high monthly premiums of participating life insurance are its biggest drawback. The premium rate is based on personal factors like age, gender, health, family medical history, lifestyle, and occupation. On average, whole life insurance is more expensive than term life. Second, you must be insurable. Whole life insurance policies are usually medically underwritten, meaning you have to give proof of good health. As part of the life application process, you will be asked questions about your health, lifestyle, and family history. Serious pre-existing conditions such as cancer or risky hobby, dangerous employment, or criminal background can all be cause for denial. If you're rated as high risk, you can still get life insurance, but with a higher monthly premium. Third, the cash value grows slowly and gradually in the first year. You will often have to wait a few years before you can begin borrowing against it. Fourth, you're not obligated to, but expected to repay the loaned amount. If not, your benefit would be reduced by the insurance company upon death. Finally, IBC requires a long-term commitment. Infinite banking is not a short-term plan. If you get a policy, you need to wait for several years to enjoy the benefits brought by IBC. Since you're paying into the policy monthly, once you start, there really is no going back. After knowing all of this about infinite banking, is it still worth it? Generally, infinite banking may be a good fit if you're a high earner, especially if you have stable cash flow and are comfortable with a high level of commitment. Thus, infinite banking is not suitable for the vast majority of Canadians. 70% of Canadians make less than $80,000 a year, or have varying cash flows, which could make it challenging to maintain your policy over time. Besides, even if you are wealthy, you must implement it correctly to benefit from infinite banking. But don't be disappointed if infinite banking is not for you. There are reasonable alternatives. First, you can consider term life insurance. Usually, term life insurance is 10 to 15 times cheaper than whole life. Second, tax advantage accounts like a TFSA or an RRSP can be wise alternatives. These accounts enable you to save your money for retirement without many financial commitments. Finally, creating an emergency fund by opening a high-yield savings account and gradually building it up to 3 to 6 months worth of living expenses is a worthwhile goal. Overall, infinite banking is still a new and often misunderstood concept. It may be suitable for people who distrust institutions like banks or the government, have high income, and are comfortable with a high degree of commitment. Take careful consideration about whether to buy into any infinite banking concept. Still not sure if it's right for you? Reach out to an independent Dundas Life licensed insurance advisor today. We can discuss your options and help you find a plan. Infinite banking or not, we'll find the plan that's right for you. If you found this video useful, please like it, leave a comment, and subscribe to our channel. Thank you, and until next time.